Good morning, ladies and gentlemen, and a very warm welcome to the 2018 MGAA conference here at the Hilton Bankside. Now, I've had the honour of being the MGAA's chairman for over 18 months, and last year was my first conference as chairman. And I said then that we were living in interesting times, and obviously nothing's changed. We got more regulation than ever. We've just endured the GDPR, and then we've got the new IDD, and of course the SMCR coming, and no doubt everybody is going to be better for it. We're still in the longest soft market ever, at least for now. It may be the new paradigm, but maybe not. The uncertainty of Brexit continues. We still don't know where we are with that. In fact, we don't know an awful lot more than we knew a year ago. The immediacy of insurtech is still with us, whether it's friend or foe for us MGAs. The number of MGAs continues to proliferate. It is the obvious structure for entrepreneurial underwriting startups. It doesn't require a rated insurer balance sheet or Solvency II compliance, and so startups can get on with underwriting. Insurtech startups would logically evolve into an MGA structure, not that they necessarily realise it. Insurer consolidation, no bad thing, but it's not all entrepreneurial, and not all entrepreneurial underwriters want to work for giant corporations. Many brokers and some insurers have created MGAs. Obviously, they need to manage their conflicts of interest, but a lot of these do have merit. And of course, insurer consolidation leads to reduced staff numbers, and not all of these can readily find jobs, and it seems some insurers are all too ready to give them paper to start up as MGAs. Now, the MGAA membership is increasing in line, and we have almost 140 MGAs now in our membership, writing well in excess of £5 billion of GWP. So why do insurers back so many MGAs? Now, I've used the word earlier on several times, being entrepreneurs. It's difficult to be an entrepreneur in a giant insurer, but it isn't difficult for a giant insurer to recognise this and support entrepreneurial talent within an MGA. There's a lot of unrivaled expertise in the MGA market. There are many profitable niches that insurers just can't access other than through MGAs, who often understand their customers better than anybody. It's a way to back insurtech, as I mentioned earlier, and it's even a way to try before they buy. MGAs don't just add expense, they can often remove expense. And so they're not just another mouth to feed in the chain necessarily. They can actually improve the profitability, not only by profitable underwriting, but by saving cost. It's not all good, though. It's also one more way for insurers in a soft market to go for top-line growth. And top-line growth as an end in itself, pursued carelessly, can end in tears and often does. It's a quick way in and out of new lines of business, and decisions made in haste can rarely end well for anybody. And why do some insurers appear to back so many MGAs that compete with each other, often with the insurer themselves, for the same business using the same paper? It can look absurd, I'd imagine, to customers. So there is some great stuff going on out there. There's also a little bit of baffling stuff. And here I come to one of the points I made last year too, in that we've been saying for years, all of us, everybody I meet in the market, whinges about the soft market and when will it end. And we all want a hard market, but we need to be careful what we wish for, particularly as MGAs. With the amount of capital about, it might be the shortest hard market in history if and when it comes. But more importantly, it will lead to blood on the carpet. People lose jobs in hard markets, and poorly performing MGAs lose their paper. Yes, premiums rise and profits can be made, abnormal profits can be made, but MGAs need to be there to take advantage. Now, we've seen with the Lloyd's results this year that Lloyd's has had to tackle their triple-digit combined ratios. And Lloyd's, of course, backs so many of our membership, and internationally so many MGAs. And they're challenging the consistently unprofitable syndicates to tell them why they should still stay in business. They're urgently tackling the need to improve results as well through requiring all the syndicates to notify them of their worst performing 10 percentile of their business and what they're going to do to put that right and turn those operations around. And say that they're going to either sign off on those plans if they're credible or force the businesses into runoff. And actually, I think this time they may mean it. It'll be interesting to see. The FCA focuses on customer outcomes, and theoretically that's a job that should happen naturally in a competitive market, so it's a shame that it's necessary, but sadly the FCA are necessary. And they've come a long way with that. And we've seen in the last year at the MGAA that the PRA too is now recognising that a lot of underwriting is outsourced to MGAs, and they expect insurers to oversee them properly. And so I think oversight of MGAs is something that we all have to go through our cover holder audits and things, but it's something that the PRA is expecting insurers to do diligently, and ultimately it'll cost them capital if they don't. So MGAs need to add value. Most do. Some don't. So I see all of this change as good. It'll lead to quality MGAs thriving, delivering great products that really work for their customers and for their capacity providers. And all of this creates change, and of course change takes effort and costs. Most MGAs are relatively small businesses, and living in this brave new world won't necessarily come easy to small businesses, and that's where the MGAA can come in. And we've got a lot to do. We spent the last year starting to implement the strategy that the board agreed when I became chairman. For example, we'll shortly be launching MGA Assist with the CII, which will be a crucial support tool for members' training needs, particularly relevant with the oncoming new IDD. We've launched MGAA Next Gen, which has been set up to represent and voice the interests of the next generation within the MGA community. We've got a dispute and reconciliation and grievance process now. We've been exploring the possibility of those member firms that wish to achieving chartered status, and the CII has now submitted a proposal for outline permission to grant the title Chartered Insurance Underwriting Agent to the Privy Council, and we're on the edges of our seats waiting for that response, but it's looking positive. We're looking carefully at binder wordings, and I've said before that I'm quite anal about these things and actually read things that I sign before I sign them. And binding authority wordings are generally on the Lloyd's templates or something like that, and they have to be some of the most one-sided agreements I've ever seen in my life. And we all sign them, and we've got some work to do on that. Lloyd's has also already made great progress themselves on the single cover holder audit and avoiding some of the frustrations that we've all encountered previously. My company last year had 7 audits from different insurers. We need to work harder on bringing the company market in on this, because individual companies have yet to get together and try and streamline this process. Obviously, there's the B word, and I was surprised at the amount of EEA business that our members write. It's rather more than I expected for smaller UK-based MGAs. And our Brexit committee has held frequent briefings to disseminate information. I'd hoped that the MGAA might be able to actually provide a solution, but the interesting thing is that our members are so varied and diversified that actually no single solution is going to work. But certainly we're giving as much advice as we can. And along the way, the association has done the day job too, representing members' interests with regulators, markets, government, etc. None of which could be achieved, and I need to mention them, without our sponsors led by Tokyo Marine Kiln, our principal sponsor, and Ergo, BLM and Arch. So for me, the current imperative for MGAs is to grow profitably. Profitably for the insurers and for the MGA itself. and to provide excellent service. Our expertise, service and culture set us apart from others, and it's that we need to focus on. Now, our theme this year is MGA's The Future of Insurance. We have a truly exciting lineup, of keynote speakers, panel debates and fringe sessions, together with our signature exhibition in the ballroom area. Grahame Chilton will shortly kick things off, and Robert Hiscox will bring the day to a close. The morning panel debate is 2018, the here and now, at 11 o'clock, when we'll be looking at what it takes to run an MGA in 2018. Post's Insurance Personality of the Year, Sian Fisher, will chair the panel, looking at the key things affecting MGAs right now, including regulation, entrepreneurship, innovation, talent, and of course technology. The afternoon panel debate is 2028, The Future of Insurance, at 2:15. Last year in one of our panel debates, we asked the question if TechSure would happen. Well, a year later, I think we can say with some certainty that we're on our way. And the famous or infamous Mark Gagan of Insurance Insider will take the panel on a journey and explore what lies ahead in the future. MGAA Next Gen is running some fringe sessions starting at 10 o'clock with speed mentoring, and then a panel debate on social media at 1 o'clock. And finally, CMS are running a compliance surgery all morning. Our keynote speaker this morning is Grahame Chilton, as I said. Described in the press as a great leader and a plain speaker, Chile has had a long and successful career spanning more than 30 years in the city. He was appointed as CEO of the Benfield Group in '96, was part of the management team that led the buyout of Benfield in '98 and embarked on an expansion program of organic growth and acquisitions that led to a listing on the stock exchange in 2003. He also oversaw the successful sale of Benfield to Aon in 2008, becoming part of the global executive of Aon, before transitioning out of the business in 2012. Since February 15, Chile has been the CEO of Gallagher's UK-based broking and underwriting operations, having worked in close partnership with Gallagher's since December 13, when reinsurance intermediary joint venture Capsicum Re was launched. He's a member of the senior leadership team of parent company Arthur Gallagher, and of course it was recently announced that he'll be stepping down from his current role later in the year. Now, Chile's passion is motorsport, with two sons being professional drivers apparently. But what most people don't know is that he's the principal owner of the Carlin Motorsport team, known as the Drivers' University of Motorsport, with nearly a third of the current drivers in F1 and IndyCar having learned their trade there. So he's been a remarkable influence not only on the insurance and reinsurance business, but also motorsport. And I believe he'll take some questions after his talk, and so maybe we can grill him on that as well. So over to you, Chile.
Great. Thank you. Well, that's what we like to see, standing room only. I hope everyone can hear me. I'm going to ask for your forgiveness because I'm a little tired. I've just got in from New York this morning. It was only 12 hours ago. I was dancing around a bar when Trippier scored that wonderful goal, teaching people in the wrong end of Jamaica, which was the only sports bar I could find near JFK, football's coming home. In fact, the only thing that did come home was a rather fat broker on an aeroplane. So if you see me going like that, there's no excuses for any of you to fall asleep. All right, I've been in Iowa, New York, and London in the last 3 days. So if anyone falls asleep, that's a problem. All right. So I was really delighted to speak because many of you may not realise, but Gallagher's globally writes around through their MGAs in the US and in the UK in a totally independent from the broking company. We write around $1.5 to $1.75 billion of premium on behalf of insurers. And therefore, I fully understand the benefits of having professional MGAs and the MGAA and the work that they do with you all. So I was absolutely delighted to come and be able to speak here today. I was asked to give you a bit about my background. Well, I think you've heard that. I can't really add to that, other than I see old Basher Birrell here, who we started as cargo brokers in CT Barings more than not 30 years, over 40 years ago, I think it was. But it was for me. You were a bit younger than I was. But I quickly went into, my boss told me, Chile, you're never going to make money doing UK cargo. Get into energy or reinsurance. So I decided to do energy reinsurance to take a double bet that would sort of work. And so that's sort of a little bit about me. But sort of, although I was a retail broker, I've done reinsurance, and I set up Capsicum Re 4.5 years ago with Inside Gallagher's. We now have 5 offices globally. I always have to have an office in Chile. So we have 1 office in Chile just because it makes me laugh. I like to get a Christmas card from the team in Chile. I have 1 in Sao Paulo, 1 in Miami, 1 in Bermuda, and 1 in London. We have about 120 people working in Capsicum Re. We handle about $3.5 billion of premium, reinsurance premium into the market on about an $85 million fee business. So that's been quite a journey for the last 4 years. But I haven't really had a lot to do with that because Gallagher's asked me to come in to take over as the CEO of their international business 3.5 years ago to try and turn things around in the business. And I've been on a great journey with a great group of individuals. The trick I've always found as a leader is surround yourself by people who have better educational capability than you do, that work harder than you do, and take good direction and get on and do it. And I'm very pleased that we managed to do that in the UK. And as you'll see from the results of Gallagher UK, it's now got the leading industry organic growth in all of its businesses and is set fair. It was never my plan to come out of retirement to do that, so I'm going back, as you were saying, as I'm stepping down, going back to as the founding partner of Capsicum Re, because that's really where I bowed from. And I was asked to look at my first experiences of MGA. So it's not a classical experience for me. My first MGAs that I came across were in fact, there weren't many in the cargo on the retail side in those days. I can't think of any. But the first ones I came across were obviously reinsurance MGAs. They were highly fashionable, shall we say, back in the 80s and 90s and early 2000s. And so I thought I'd talk about my experience as probably the leading one at the time, which was Fortress Re, which many of you probably don't know, I would have thought. They wrote probably in excess of $500 million of premium from the US. It started in New York and then they moved to the Carolinas. It was started by a chap called Chuck Saber and then taken over by Kenny Kornfeld. They were major writers of aviation. They led the general aviation market. They also led the aviation retro market. They led the primary end of property retro. They also had a major multi-line class business. And in fact, probably post-Hurricane Andrew, they probably accounted for 35 to 40% of the market capacity, which kept many of the professional reinsurers at that time going. However, I'd never come across them coming as a cargo broker. I'd never seen one of these MGA things. So I thought, I've always had a passion for ensuring you don't get customer detriment. So I thought, well, MGA, so they've given the authority to this guy in Carolina to write business in London. Okay, right, okay. That sort of seemed a bit weird to me. So I said, could I see the underwriting agreements? And I, to this day, have never seen anything so wide. It was a 3-paragraphed letter signed by the chief executives of the 4 Japanese companies that they were underwriting on behalf of. And basically it said that they could write any class of business, whether insurance or reinsurance, up to any limit and any exposure, and that they could also buy reinsurance on behalf of the companies. So it's a complete thing. And to a certain extent, that comforted me, because now I look at MGA agreements, and you have to be very careful, as you were saying, because a lot of things are carved out of them. And to a certain extent, where you could really get an issue of customer detriment is where the underwriter is not aware of his agreements and writes stuff outside those agreements. Anyway, going on, the thing that reminded me of this was there's a reinsurance conference every year which is held in Monaco, and tragically, the last time I spoke to the underwriter of the Fortress Re pool was about 10 minutes after the second aeroplane hit the second tower in 9/11. And at that stage, I'd been having lunch in the grill room there with one of our clients, and basically I got this message. Someone came running in, Chile, can you come down to your room? There's lots of Americans banging on the door trying to get in. So I rushed down to my suite, let everyone in, because obviously they were hearing this and they knew where my room was because we had this large Benfield suite at the time. And we sat there and watched these tragic events unfold in front of us. And of course, that was the beginning and the end of reinsurance and retro MGA pools at the time. We just brought it to a stop. And in fact, Fortress Re, from going and writing over $500 million of cat premium, never wrote another risk after 9/11. And the underwriter got me on the phone, and you know, I had grown men in tears at the time in this room. I probably had about 50 people in my room. I mean, you know, I haven't had 50 people in a hotel room in my life, contrary to anything you've heard. It was a shocking turn of events. And anyway, I then get this sort of very quiet voice. I don't think all the money in the world can pay the tragedy that I'm watching unfold. Now, I didn't see that underwriter for 5 years. The next time I saw him was in an arbitration on behalf of one of the clients, which was being held in New York, and that was the final claims payment. One interesting thing happened in that meeting, which I think was interesting. These are the final claims that had to be settled. And the underwriters who set up that business, Chuck Saber and Kenny Kornfeld, had their own carrier called Carolina Re, which was a Bermuda company which sat behind the Japanese with a full quota share with the agreement of the Japanese companies. And I think had, by that stage, amassed between $300 and $400 million of profitability into that business. And they'd agreed to pass that money back through the to the customers. So basically all the funds that they'd made up. And it makes me think at times, when we look at customer detriment, that some way of maybe ensuring that we can get some retention of profitability that can go to the customers in the event of the carriers that you represent not paying claims. Controversial, I know, but to a certain extent it's quite an interesting concept, because I think you only get a few rogue MGAs to bring down a house of cards, because I think it's really important that we look at the whole regulatory side of this business. So I'm a great believer in robust regulation, and I think it's key in today's transparent world. And that neatly turns our mind to regulation in the MGA space. The current rather light touch of the mid to small size MGAs, I don't think is something that's going to carry on. As a broker, I've seen enormous changes in the whole regulatory environment, and I think it's important as an industry one accepts that this is going to get more. We heard from Charles, PRA are interested, the FCA, and quite rightly. And obviously a lot of that attention, because it would be, is aimed at the larger MGAs. But it is going to come down the pipe, and I think it's a responsibility of all of us to ensure that all MGAs have a robust risk and governance framework, a delineation of responsibilities, and to be able to demonstrate always that they are serving the best interests of all their stakeholders. Today, the increasing model of MGAs that are becoming more of a virtual insurers is an interesting one. And I think that's probably the way ahead, i.e., they should underwrite as if the capital was their own. They should ensure that there's first-class actuarial work going on, that they understand the commitment they're making to the paper. And I would ask you, on behalf of the broking community, to ensure that you know your clients are going to get their claims paid because you've done the actuarial analysis, you do the right reserving, and you know your insurers are going to stand behind you because you've done a professional job. And I think then, if we can do that, I think there's a very, very good future for the further proliferation of the MGAs, which I'll go on to explain. But whether it's an insurer or an MGA, any form of reckless underwriting with no capital or minimum capital and an absence of regulatory oversight, it can't be acceptable. And it cannot be accepted in today's market by ethical, customer-centric brokers. So brokers will look more and more at the agreements and the performance of the MGAs that they give to clients. We really need to therefore question what carriers are getting from their rogue MGAs today, because all I can see in that relationship is headaches and sleepless nights. And I know many of you as members of this will want to see that professionalism brought in to all of the MGAs, many of which aren't members here, because we all know where they are. And I think taking out all of the rogues, we all have a role to play. As an industry, we therefore need to question and call out some of the worst exponents. And, I'd say again, why do I feel that way? Because it will only take a very few rogue businesses to cause tremendous customer detriment, and that calls into question the behaviours of many of the excellent MGAs we have in the business today, who are in many instances underwriting to a far greater standard than certain insurers I know. And as a broker and a reinsurance broker, I know which I would rather partner with. As someone who has been around the block, I'm increasingly surprised how certain underwriters in standard insurance companies or MGAs get given the authorization to replicate the problems they have caused many times before. I think it was Warren Buffett that said in one of his annual reports, it's like the insurance manager who is already in a hole and doesn't know when to stop digging. We've got to make sure these people are found out. It's all of your futures. I'm an old fart, so it's not my future, it's your future. And so where you're seeing it, you need to call this behaviour out. Sorry, a bit serious for me, I know, but I feel quite strongly about it. Now, I think specialist, not standard. I think the real role of many MGAs today is finding a niche. And just as it is in today's broking world, the mantra of being specialised and not standard is also key. Surviving and thriving in today's complex global risk environment. If I go back sort of 10 or 15 years of dealing with certain smaller MGAs, I quickly realised that as a broker, I knew more about the client, more about the risk, and how to price it with my own actuaries that I employed. I employed at one stage in Benfield over 200 actuaries than the MGAs. And the insurers were giving the capital to MGAs who didn't have any actuarial pricing capability. Extraordinary. Right? So to a certain extent, I really welcome the virtual MGA of tomorrow. And then running off significantly lower, I do believe that the virtual underwriting businesses are running off significantly lower cost bases than many of their household name insurance competitors, leaving them in a much better position to deliver better service and better value to their clients and the brokers that support them. Some of the best underwriting in specialist classes today lies in the MGA market in the UK. Right? So, I absolutely am an enormous supporter of that specialism. There's some standout examples in some of the small wheel motor business, cyber, terrorism, specialist household businesses, other commercial insurance areas where it's in those niche areas. I am proud that we have those specialisms in the MGAs in this country. I think it's a really vibrant part of the industry. I'm particularly attracted to certain of these MGAs when we see some of the most professional distribution and underwritings in any industry in the world. I do business all over the world, and some of the smaller niche MGAs will bring distribution in a way which we aren't seeing around the world. So congratulations to those that are doing that. And I think with the lower cost basis than in many insurers and the specialist nature of expertise and strength of relationships with cover holders, makes them more fleet of foot and responsive in their underwriting capability. So one of the other questions I was asked to sort of look at a bit was the emerging opportunities and threats, and to be ready for those. And as I look at other opportunities and threats, as the professional virtual insurer model gathers momentum, efficiencies of bringing capital risk will only increase. We can already see this with the more efficient reinsurance capital and ILS market looking for ways to get closer to risk. Going forward, we can expect to see, as we saw in the reinsurance market, enormous strides being made by the ILS market to access non-correlating volatility for their investors. And they will look to support MGAs through transformers. As we're already seeing in the property cat, you're going to see it in many other areas. And why will those organisations and reinsurers be successful? Because, again, they have significantly lower expense bases than the current suppliers of capital to our industry. And at the end of the day, for the customer, the cheaper the cost of capital will allow them to write and survive when we see the loss ratios of today. If there's 15 points of friction in a deal, it isn't going to be a survivable thing. So it is a threat to the classical way of looking at these things. And I think everyone has to be aware of this. However, it's a real opportunity. Because if you can write to a standard where those ILS funds will want to support, you will be able to be much more competitive and therefore grow your business because you'll have a more competitive offering. But this must all be achieved while ensuring profitability to all involved in the chain, both the carrier, ultimately, whether it's the ILS funds, reinsurers or insurers, and also to the MGAs themselves and to the brokers. Because without that profitability, the business doesn't survive. And, you know, we have significant concerns, to my mind at the moment, with the industry, with the loss ratios that we're seeing and the standard of underwriting, when we've had more pricing actuaries than we've ever had before, and we've got combined ratios in the over 100%. What's going on? You know, it's this thing of not stopping when you're in a hole. All right? And it's just terribly important. And I suppose I'm now old enough to be able to say that because I can say what I like, but it really worries me. I care about this industry enormously. I've built businesses all over the world, and I'm shocked to see the standards that do go on at times. However, as long as we appreciate that unprofitable business is unsustainable, and therefore without that the client doesn't receive the stability and security that they crave whilst making an insurance purchase. That's why people buy insurance. They buy it for security. And therefore underpricing a product does not give them ultimately that security. So I believe from many of the virtual MGAs, virtual insurer MGAs I see today, that there's a bright and exciting future. There's the seeds of a firming market. Is there ever going to be a hard market like we saw post 9/11, to go back to that story? No. Because that volatility came because there wasn't enough property cat coverage. The ILS markets now have more capacity than you can ever imagine to write property cat. They probably ultimately take 70% of that exposure already, and they crave volatility. We're only slightly saved because they struggle to deal with some of the casualty classes at the moment, but we're starting to see ways of breaking that down. We can look at tail covers, all sorts of things. But, believe me, the efficiency of their capital is a threat for our business, so it's important that everyone realises that. But I've always been a great believer, as a rather fat broker, that when there's disruption, there's an opportunity for profit. And there will be opportunities for you all in that time. The more efficient capital comes into the market, and so we can expect to see this alternative capital will come to the fore if the market hardens, which I rather suspect, therefore, will stop it hardening, because my economics master from Manchester Grammar told me, didn't get my economics A level, but never mind, we won't worry about that. Seems a long time ago now. I got woodwork there. But as he said, as he said, it's all about supply and demand. And there's too much supply of capital chasing too little business. And that ultimately brings about a reduction in price. So the market increases the value of the MGAs that operate as a virtual insurer model, and we will start to move hopefully into a harder market. I predict that only these true virtual insurers will survive. Only those MGAs that really deliver great technology at a low cost base with professional specialist underwriting services will survive the transition. Many people ask, will this lead to a consolidation? Well, at Gallagher, we regularly see MGA owners looking for a good home for their business. I advise everyone to choose their partners well and carefully. You know, at times, VCs, best conversation is the first one. Those of you who have sold to VCs will know that. It then gets progressively worse. So those of you who are looking to sell your business, be very careful where you sell your businesses to. So MGA owners looking for a good home for their businesses, I think, should seek out only a strong, ethical, well-governed virtual insurer for their sale. Stable and longevity for the future. I see it as a very exciting time to be an MGA. However, there is as critical a role for brokers and carriers to responsibly develop these opportunities. I believe there is a very bright future for MGAs that get it right. And getting it right means achieving the right combination of governance, customer centricity and specialist offering, all delivered to exacting underwriting standards with pricing and actuarial support allied with the seamless systems and an acceptable cost base. That, in my mind, is the formula for the successful MGA of the future, which I know is one of your comments. Anyway, so I spent a lot of time now being sought out by some of the emerging new tech-based MGAs to not only review their business plans, but assist in finding paper and investors for these businesses. It is very clear that many of the most imaginative things happening in our business, in the insurance industry today, do start their life within the new breed MGAs. And although we cannot invest in every opportunity that I see, we certainly look to get involved in helping them establish their business with their own professional understanding of the insurance marketplace, investors and carriers. It feels like this is the time of the MGA, a pivotal moment, a day of reckoning, making it an exciting time to be sitting where you are today. The critical role you play for brokers and carriers creates a bright future for those that get it right. And getting it right means robust management and governance. I'm sorry, I bang on about that because I think a lot of people forget it. No successful business will be badly run. So you do need all of the value-added service, special capabilities, and strong, healthy, long-term capacity. I think get that right and you'll all have cracked it. Thank you very much.
You'd be delighted to hear that a number of questions have come through. A couple you've actually dealt with, one in respect of a hardening market. So let's kick off with the first one. How do new or small MGAs control compliance costs, in your opinion?
Get bigger. It's an unfortunate, it is an unfortunate part of the business that isn't going to go away. At the end of the day, we've seen it in the broking community, I've seen it in the underwriting community, seen it in the MGA community. It is only going to increase. I think the sort of fashionable, well, we'll farm that responsibility out. Yeah, I'll be very careful, because unless you take it seriously as a business, then it won't. So for all of us, I think there is an increasing cost to our business of doing this. And why is that? Well, I talked about it, calling out the rogues. The reason why we need more compliance and regulation from third parties in our business is because as an industry we haven't done it very well ourselves. So the way to get the cost down of this is take it seriously, run your businesses and treat people as you'd hope to be treated yourself. And call out the rogues, because they're the ones that are pushing up the compliance and regulatory costs of your businesses.
Thank you.
Yes, sir.
We have the next question is, what are the characteristics of a good capacity partner for a modern day MGA?
That's a really tough one to answer. I think the modern capacity provider of today needs to bring efficient capital, i.e. they need to have cheaper capital, which allows for the friction of the MGA structure. One that actually buys into the whole pricing actuarial work that carrier is doing on that business, and I think probably buys into, with their claims side, the reserving side with the claims side within the MGA. So you need to work closely on all those areas. So you need to be aligned with your paper provider over how you manage claims, what systems you use, how they're reporting, and I think it's a carrier that has efficient capital and wants to interact with the MGA because they're specialist capabilities.
Thank you. There's a number of questions here on technology. How do you believe technology can help MGAs? Are there any examples of insurtech businesses leading to MGA startups that you can tell us about? And finally, do you see insurtech as a way for MGAs to grow their niches efficiently and keeping customer-centric? So they're all rather around.
I think it's a really interesting thing. I think the startup tech vehicles that have gone, I think the one that springs to mind is Lemonade, which is the personal lines carrier based in California. Now, it's quite interesting. They have to use I can't discuss it, but they use a lot of broker services in putting together that, but they're a carrier, and I think they have something like 140 against their own paper, about 150% loss ratio on personal lines business, which it's quite easy. That's without cats. That's without a cat load. So to a certain extent, I think the tech startups going down the MGA route is actually a real opportunity, because to a certain extent it's this virtual, it's distribution, having good distribution through tech, understanding the market you're trying to send your business into, I think is a really interesting area. I mean, we do a lot. I go out and I talk to our clients on the insurance side, and in the old days they tell me they're really worried about their fire risk, or they're worried about this risk. All they talk to me today about is their cyber. Well, they don't say cyber risk, they talk data breach and words like that. That is their principal concern. So one has to accept as an industry, we're going from being a P&C industry to a P&C industry. And it's very important that cyber class is not just thrown in. So you have affirmative cyber, which is where you're giving cyber coverage and you fully understand the coverage that you're giving. It's priced. It has a set wording. The trouble is many wordings out there that you put out has a silent cyber or non-affirmative cyber. So you haven't meant to give cyber cover, but you have. So I think, you you have to be very careful, but I do think it does lean itself, because it's the cyber business, it's about data breach, for that business to be handled within the MGA community. But do be very careful, for those of you that don't understand cyber, that you're not inside your policy wording, and hopefully your carriers will be all over this, not giving great tranches of unpriced, non-affirmative, or silent cyber as some people call it, in your wordings. Because it will be the biggest losses that you have. I model it. I mean, I have, in Capsicum Re, probably over 10% of my staff are cyber experts. So we have PhDs in... So in the old days, it used to be I had a whole load of volcanologists and P&C. I don't need that anymore. Everybody wants to talk to us about cyber. So a large part of our business is being the leader in, because I had to do something that was in the new area. There's no point in me just setting up a new reinsurance broker to just do what we always used to do. And it's really interesting as an industry. But what shocks me is the amount of coverage which is just being given with no price in the wordings. And what we were talking about earlier, professional underwriting. How can that be professional to just give, in the property tab, physical risk damage to cyber risk? I mean, what are you all doing? So I would get your wordings guys to really look at the cyber exposure. If you don't, your insurers will, and you will start to see that that taken out of the coverage, I believe, because everybody's looking to have a firm cyber coverage at an affirmed price for the new P&C industry.
Thank you very much. And maybe you'd like to give a yes or no for the last one, which is
that,
our broker-owned MGA is here to stay.
Well, I mean, I don't know. We're only a small one. We're only about $1.5 billion in Gallagher's. The first thing I did when I came in to Gallagher's with our MGA business was when I arrived, it was managed inside the broking business. And I went straight to the FCA because I hadn't even been approved. This was my first day in the job. And I said, no. We're going to put that in a separate division with separate management, separate capital, completely run independently. And I think, I'm not saying exactly what they, but I think there was a thank for that. So it's the first thing I did. And so, yes, sorry, I'm not bang on. Absolutely, I think brokers do bring something to the party because of the robustness of the actuarial pricing that we put into the business, the CUOs that oversee any of the line underwriters. It's a very professionally run organisation. It's totally independent from our broking business. In fact, it's more difficult for our brokers to show our MGA's business than it is third-party brokers. It's more hurdles.
Thank you very much, Grahame.
Thank you.
Thank you.
Cheers.